going to introduce Ross Kelly, who's the head of partnership at Seedrs. Seedrs is the most active private equity funder in the UK and Europe's leading equity crowdfunding platform, having raised over 970 million in total, over 1,150 raises. In the last couple of days, they've just announced their merger with Crowdcube, the UK's other leading crowdfunding platform. So we're excited to maybe hear about that, maybe not. But prior to moving to head of partnerships, Ross supported founders directly in the Seedrs campaign team, which helped fund deals such as Innocent Gun and TV Fit. Thanks for joining us, Ross. Chris Wichert is the co-founder of Koio, which he founded in 2015 with his co-founder, Johannes. Koio's mission is bringing old world luxury into the digital era through handcrafted sneakers. And Koio is dedicated to offering timeless shoes constructed by craftspeople that are fairly compensated, receiving their rightful share of the value that's created. And at the end of last year, Koio announced Series A rolling close of $6 million for a total $9 million led by Founders Fund. Thanks for joining us, Chris. And finally, Will Orde, who's an investor at Downing Ventures. Will joined Downing in September 2019 as principal in the ventures team. He focuses on backing early stage companies, building tech-enabled brands, online marketplaces, and fintech businesses from Truba to Zyper to Trinity, London. And prior to joining Downing, he was an investor director at Oxford Capital, where he spent 7 years investing in early stage digital startups. Guys, thank you so much. I mean, there's an amazing wealth of experience here from both the brand side and the finance side for our community to sort of dig into here. And what I want to start with is really from the brand side is what are the options of fundraising when you're looking to go out and raise some money? And I want to hear a little bit about from Jess and Chris first, what drove your decision to go out and raise money and the strategy behind it. So Jess, starting with you, what stage did you guys decide you needed to go out and raise some money, and how did you decide what the right type of funding was for you?
So we raised 6 months after our launch. So for us, it was super important to first prove that there was some demand for the product before taking some outside investment. And what happened with us basically is 2 months after our launch, we basically started without any funding, really like bootstrapping. We've put like $5,000 each into the company to make a website, to like create product and start selling. So like we were really more selling to friends and family, really trying ourselves by cold emailing people to get the word out there. And actually 2 months after our launch, Meghan Markle was in wearing our pieces, which like helped us grow and definitely gave us a lot of credibility and a lot of visibility all around the world and in the industry. So we thought that was a good time to go out and raise, because like we had amazing traction. We've seen there was great demand, and we really wanted to take advantage of it to be able to like show investors that there was a demand for the product, but that we needed the funds now to be able to scale and go the next mile. And in terms of like, why did like we basically raised from like a fund and angels investors. But when we started, we thought that we would start with friends and family, because I feel like that's the easiest way to go at first. And that's also what people usually tell you. You should like raise from friends and family. It's easier. And it's just really more about like relationships, telling your story, etc. But for us personally, we quickly realized we didn't want to mix friends and family and business. We really rather wanted to prove ourselves and take on the challenge of like raising from outsiders and people we didn't know. So for us, it was all about cold emailing women that were aligned with our product, that really could understand what we were selling and what we were trying to do with that new innovation of lab-grown diamond, etc. So we really focused on angels investors because we thought they have the experience that we don't have. Those are people like us, but that can teach us so much that like usually like a fund maybe won't, and also give us access to their network, which is like really, really important when you sell a product. It's really all about word of mouth. It's like getting access to the right people. So we decided to go that way. And then like from one investor to another, we got in touch with like a few funds. And that's how we decided to accept the fund and take some and most of angel investors.
Amazing. Yeah, it's definitely a different way to start, which is great.
Yeah.
Chris, how did you guys approach raising money for Koio at the very beginning when you guys launched the business?
Yeah, thank you, Josh. We actually were in the position where we needed money right from the get-go. My co-founder and I, we met during business school and started working on Koio during business school as well. But yeah, I took out a loan to pay for business school and he was sponsored by a company. So we didn't really have money on our own to put into the business and needed money from the get-go. The first thing that we did was we did a small friends and family round from peers at Wharton, people that saw us working on this, that were excited about this idea. They put in a little bit of money and I think we raised around like 100,000, which financed our first production batch, the design of the shoes, and just like the first initial steps to really get started. Then post business school, we moved to New York. That money was gone. We had our first production batch and we were about to launch. And we figured we need more money. We needed to pay ourselves a salary, which was a key factor for us to be possible to take on this venture coming out of business school and to live in New York and to build this business in New York. So we told ourselves within the next 6 months, we need to get some seed financing on board through angel investors and potentially VC investors, or we have to stop this endeavor, because otherwise my co-founder would have to go back to his company before business school. And in order to pay them back what they paid for business school, our goal was like, let's do this, let's raise financing. Initially, we thought, okay, 300,000 is going to be enough. Let's go out, let's talk to a few people. The first conversations were truly a disaster. We didn't know how to do it. We didn't know how to present the business. We didn't know what investors were really looking for at the time. But we practiced and I think got better at it. At the same time, our company was getting some traction, similar to what Jess said. We had some good celebrities wearing our shoes. We had some press features in GQ and Vogue, and it was slowly getting off the ground. Then we met one investor who said, well, I'd be down to invest in you guys. I'll give you 200,000, but only if you can get to 1 million and not 300,000. And that was the key moment for us where we like really dug into how much money we needed, what the business model will look like, and started thinking way differently and way bigger about the business. So we ended up raising a seed round of, I think, $1.5 million in 2016. And one of the big learnings for us at that time was like, really think hard about your business plan, where you want to go and how much money you need. Ultimately, the $1.5 million that we raised, even though we only wanted to raise 300,000, also only lasted a short period of time. And then there again, we were out raising again.
Yeah. Well, we're going to get into how to get in front of these guys and convince them to give you money. But I want to go on to Will from the finance side, obviously, and talk a little bit about, we often hear venture capital being talked about when talking about startups, but obviously it isn't right for every business. Can you tell us a little bit more about what business models work best for venture capital, what you guys tend to look for?
Yeah, so kind of venture capital is fundamentally a hits-driven business model. Kind of the businesses that any VC invests in are super risky. They're expecting a good portion of their portfolio to end up failing and not working out and kind of being zero returners. And so to kind of make up for that, the businesses that succeed need to succeed big. And that's why you see people getting so excited about kind of unicorns and super fast growing businesses. And it means that kind of VCs they're looking for, and we're looking for kind of businesses with the potential to deliver kind of large outcomes. You're talking kind of, how do I get to 100 million plus in revenue? Those are the kind of questions we're asking ourselves. and so it's big market. It's the ability to grow rapidly into that, to acquire customers aggressively and kind of become category leaders or define new categories. And that's not going to be right for every business. Kind of there's founders and kind of the CEOs and the guys running the business. You've got to think about, where do I want to take this? And it may be that you want to think about kind of words that can sometimes be a bit dirty in the venture capital landscape, like profitability. And it's very rare. And I think that we've got a portfolio of 77, 78 businesses that we've invested in. I don't think any of them are profitable, and because they're kind of trying to grow ahead of the ability to generate profit and kind of constantly reinvesting back into the business to drive growth. And so taking on board kind of money from VCs or kind of angel investors, it's no longer just your expectations and ambitions for the business that drive where it's going to be. You've also got investors who've got expectations and kind of ambitions for where they think the business should be going and what they think a good outcome is. And if you're not aligned with them, then that can cause problems. Absolutely. So you need to kind of think that through before you go out raising, and think about where you want to take the business, and if you want to go on that kind of throw it all to the wall, go for growth at all costs type approach.
Yeah, absolutely. Ross, you sort of come from another part of the financing spectrum, which is crowdfunding. Can you tell us a little bit about how Seedrs works, and what sort of brands benefit from crowdfunding in general?
Yeah, awesome. I guess it probably helps to give a bit of context about Seedrs generally, and how the entire business was started, because it's very relevant to what we're talking about here. But Seedrs has been about since 2012. The idea was actually formulated a few years before that, funnily enough, at business school. But the mentality was, if you're actually looking to get a business funded and you're an early stage private company, then you're quite limited to look at angel investors or VCs. And angel investors are either probably very successful ex-entrepreneurs who've exited a couple of times, or whatever that, they're already extremely connected and probably very rich. It was seen as quite like an elitist form of private equity money. And the mentality of Seedrs and crowdfunding generally was to try and democratize that. Not saying we've completely done that, but certainly the ability is now that you can actually have investors, inverted commas, people who just love your product, people who love your brand, investing £10. So actually suddenly anyone can be an investor now. Clearly you need quite big scale in order to actually fill a significant funding round with people investing £10. So what you're looking at from our side is rather than Wills Van Downing or the other kind of VCs filling up significant portions of the round, you'll actually have lots of smaller ticket investors, maybe investing alongside a venture capital firm or a big angel. So we can actually facilitate investment, over 1,000, 2,000 individual investors, aggregate them all over a nominee structure, which is like a word that I nearly became single over, because over lockdown I said it about 20 times a day and drove my girlfriend insane. Talking about a nominee structure is the most boring thing in the world, but it means that we can actually put 1,000 investors under one name on the cap table. So you're not like, the founders aren't dealing with the individual investors of £10 like on mass scale. There's no voting rights. There's no like names on the cap table. They're not filling out on Companies House or the US equivalent for each of those individuals. It's really just we represent the voices of all those crowd investors, and that was the concept. That's really what we spent those 3 years between 2009 and 2012 making sure that we had spot on. So we're 8 years old now. Like you said, Josh, we've done about 970 million in total raises through the platform. That's not Seedrs raising that much, but that's how much has come through the platform in total. We've got a merger which was announced on Monday, subject to approval from the FCA and the CMA, which is obviously much more busy with stuff like Amazon taking over delivery, hopefully to look at minnows like ourselves. But the essentially what we'll be able to build from that potential merger with Crowdcube, which is kind of our main competitor in the space, is a private equity platform that by the looks of things now would have more companies on it than AIM, which is the second biggest public market listing stock exchange in the UK. So really exciting opportunity there. Where we fit into rounds is, like I said, we can do pre-seed rounds, so we can do anything from 50k up to 8 million. That's the prospectus limit, and we've done plenty of raises which are actually alongside private equity firms and venture capital firms too. So giving people the opportunity to invest from £10 at the same valuation in the same scope as like a big recognized investor is super exciting. So that's kind of where we're at. And I guess, sorry, to answer your other question, Josh, what kind of businesses does it suit? Historically, it's been very B2C, so much more like the consumer kind of brands that it really appeals to. And I think that's because if you think at some of the bigger raises, it's the likes of Revolut, the big challenger bank, Urban Massage just did their Series B, and you're probably more likely to attract a sort of capital in mass in the sort of brand which already has 20,000, 30,000 customers, or lots of people in the email database or Instagram followers or what have you. But actually, given the fact that we have now a secondary market, so we now have the ability to both sell and buy past shares, we're attracting more B2B businesses as well. We've done a few fund campaigns, so a few early stage accelerators and VCs have actually raised their funds through the platform too. We're trying to make it more like a general marketplace. So I wouldn't say pretty much everything, because that would open up a can of worms, but we can be pretty open-minded with what we fund.
Amazing. That's great. Well, congratulations on the merger. Have fingers crossed for that.
Thank you.
And then I wanted to move on a little bit to talk about timing. So understanding what the landscape looks like now. When is the best time to raise? It's often said the best time to raise is when you don't need it. Chris, you guys have done now a few different rounds. Do you agree with that statement?
Yeah, I definitely agree with it in a way that you need to have some momentum and have some good things going for you in order to go out there and make your case and get investors on board. I think what's crucial is that you start by having a super detailed business plan beforehand, and that you are really preparing an investor network, a potential investor network that you want to talk to, and that could be a good fit with your brand. And it goes back to what Will said earlier, is really make sure that the investors are in line with your goals. I think this is the most important thing during a fundraise, that you don't get someone on board that isn't really aligned with the vision of your company or with your goals. An example could be that some investors are out for quick growth. They want to go after the unicorns. They want you to increase sales month over month. Whereas when you're building a brand, they may not always be the most suitable for you, because you have some brand equity that you're building up, and you don't necessarily want to chase revenue goals by means of discounts and sales in order to dilute your brand. So I think it's super important that you do the homework, that you prepare a list of investors that you want to speak to, and that you start practicing with some of the investors on your list that aren't top A category. And only when you have some training and some preparation in, and really what your business case is, because you will adjust your pitch and your plan after every meeting a little bit, only then you go out to the bigger ones. But I do think it's important that you have momentum, and that you have some good things, and it could be small wins going for you that will help you make your case.
Will, do you, when you see businesses come to you, what do you need? What are you looking from them? What do you want them to have proved by the time they come to you?
Yeah, it obviously all depends on the stage at which the business is raising, but kind of at the end of the day, we're looking to build kind of really strong conviction that we think that the founder and the kind of the senior management team really know their shit. They're kind of deep in their subject matter, real experts. They've got kind of a real grasp of the whole business, and they know how to drive growth. And that not only will they be able to kind of execute against whatever plan it is that they're presenting that's going to see them double, triple growth over the next year, and kind of do that short-term delivery, but also that in the long term they're building something that's going to be fundamentally valuable and sticky and can have staying power as a brand, or if it's kind of more of a tech kind of play, that the differentiation of the product they're building is going to have that kind of long-lasting differentiation. And that kind of comes from the top down. It comes from the CEO. Just kind of, I love kind of people who are just all over their business, know it inside out, and then have assembled, or are in the process of assembling, a team of rock stars around them, where you can be really, really impressed that they've got kind of a super impressive person doing marketing growth, or some kind of CTO who's kind of knows inside out what the tech is they're using and why they're using that. Kind of, it gives you the confidence that if you got excited about whatever plan they're presenting, that they're going to execute it, and that they're going to get stuff done.
Actually, that's quite an interesting point. On that, I wanted to ask, when the decision for you comes, like, what is more important to you? Is it, is it the founder or the idea? I mean, obviously it's a bit of both, but what emphasis how much emphasis do you put on one or the other?
Yeah, so you can, both are definitely important. You sometimes come out of a meeting with a company going, wow, really like the founder, but just can't build conviction around the idea. I don't think the opportunity is big enough, or kind of they're not differentiating enough from the competition or something, so we don't think they'll grow enough. And you kind of say to the founders, kind of, would love to stay in touch, kind of just not this business, maybe kind of come see us in a few years' time when you're onto your next gig, and you try and kind of keep those founders in the watching list. Equally, you can't be just business idea driven. Kind of, we're not going out to deliberately build businesses. We're not kind of building a market map and going, I want to going back a business and doing this exact thing. If we were doing that, we'd go and found the business ourselves. It's so easy for things to go wrong. There's so many things that need to come together and go right for a business to succeed and to kind of really turn into something special. And you can't do that without exceptional founders. So it needs to be exceptional founders working on something that you really believe it's everything coming together at the same time.
Absolutely. So to change speed a little bit, I want to now explore, once you're ready to go out and raise, how do you decide how much you want to raise and what valuation one puts on that business? I think it's probably a joint effort between the investors and the founders. But Jess, how important was the valuation to you when you guys were raising?
I think for us it's super different as well, because we raised so early on. So definitely, like, even when we talk to investor, what they were investing in is the founders. I think it's definitely important, the business idea, and they're not going to invest in something they don't believe in. But at the stage we were at, to be honest, like, we didn't even create a business plan. Like, for us, it was really about like going out there, reaching out to founders, angels, investors, telling them about like our idea, what we've achieved in just like a short amount of time, and like really more of a personal discussion with those investors, rather than really like showing them projections, showing them numbers, which are often bullshit. Sorry, like for us, at least when we're that early on, like we could have never predicted what happened with Meghan Markle. We could have never predicted COVID. So I think like at that stage, what's important, it's just really the founders. And in terms of valuation for us, when we went out raising, we've never done this before. So like, honestly, it was just like, as you said, like you meet an investor, then like you learn from them and you incorporate it in your next meeting. So it was really like learning while we were raising. And for us, what was super important is really not to give out too much equity. So it was our first raise. We had proven that the product was needed, but we had in our head like a percentage, like a maximum percentage we were ready to give out to investors. And for us as well, we have like a different mindset. And I think maybe because we're in Europe, because as you said, Will, like a lot of VCs, it's all about like it's rare to be profitable, and it's very hard to be profitable. And for us, like we definitely went out and raised, and I think it's amazing because it helps a brand like really achieve many things that you couldn't without any funding. But at the same time, not having too much money enables you to do a lot more even, because like you have that mindset of like everything needs to be done with like very small budget, but at the same time you have that more of a hustle mindset. So like you get things done, like you reach out to different people, but when you have the money on your bank account, it's really more like we have that agency, they're dealing with it, they're gonna reach out to those people. So for us it was really like what we wanted to give away, and the goal is really to be profitable. So like it's good to raise, we probably will raise again to help us grow, but we really have a mindset of like we're selling a product, we can definitely be profitable at one point, because honestly there is an issue, otherwise there's an issue. And we've seen it with what's going on with COVID, like all the D2C brands in the US that we've looked up to so much, that since our beginning, like all those amazing startups in New York, LA, etc. And you just realize that when something hit like COVID, it's like they're in a really bad position because all they were relying on is like raising funds, and like profitability is like so far away that we don't even know if they're gonna survive the pandemic. But at the same time, when you were looking at press, sorry, my light is just going on and off. When you were looking at press, you felt like they were like the most successful companies because they raised a lot of funds. So I feel like it's really about, it's different, like it depends what you want and what you aim for, and really make sure like if you go raising like at an early stage as we were with like such little data, know what you want to give up, and know that it's important as well to still keep control of your company and not be owned by the investors. And that was something that was super important for us.
Yeah. I mean, let's get into that then. I mean, especially from the finance guys, from Will, and not to pigeonhole you, but Will and Ross. You know, in exactly as Jess said, in recent times, when you raise money at a high valuation, there's often an understanding that the business will prioritize growth over profitability, certainly in the early stages at least. We are sort of seeing the trend reverse now after a few high-profile failures, like VC-backed businesses. I won't go name names. How does a brand, Will, Ross, I don't know if one of you wants to take this, but how does a brand balance profitability versus scaling and fast growth?
Just kind of, I suppose, brief from my side, the bit that really matters is unit economics to us. So looking on a per customer basis, how much does it cost you to acquire that customer? What are they purchasing in their first visit and kind of first transaction with you, and what's the net contribution from that? Then how much do they come back and repeat over time? And so what's that lifetime value? And the businesses that we're really happy to fund, we don't mind if you're loss making on that first purchase, as long as you're really confident that the customer will come back and repeat over time, and that you're going to be making your money over it, and you'll be making a decent profit on every customer you acquire over the lifetime of that customer. And that's where you get classic numbers like 3x LTV to CAC ratios, and you're looking at kind of acquisition payback periods and stuff like that. If you are confident, and we're confident that those unit economics hold together, you can then start to spank out marketing money, acquiring a whole load of customers, knowing that you're going to get that marketing money back through the future transactions from those customers. So that's how you can kind of run a loss-making business, investing heavily kind of ahead of the growth curve into marketing spend, but know that you'll get there at the far end of the day. I think the way that businesses have gone wrong in the past, and the example that I always kind of think about with this is bonobos, is you raise too much money, you try to grow too fast, and you try and bring on a load of customers, you end up spending more and more and more to acquire each customer. So you kind of get past your early adopters, and you've kind of got past those magic marketing channels, and you're now having to just spend a bunch of money in the walled garden that is Facebook. And the economics don't work. You don't actually end up making any profit from those customers. And then you've got yourself trapped in a situation where you're losing money because you're having to acquire a lot of the customers to drive growth, but the unit economics don't work, and so VCs aren't going to want to give you another big chunk of money, and it's a really difficult position to be in. So it's about kind of keeping a really tight eye on the detail of, is that individual customer profitable or not? Are you doing things that are scalable?
Absolutely. And then, from the other side, we always talk about raise amount, valuation. Those are the sort of key headline figures that come out. Ross, what are other terms? Well, I want to hear from actually both the brand side as well, but Ross, what are the other terms that investors or founders should be focused on? And why are they important? Some things like liquidity preference or board seats and votes.
Yeah, sure. So, I mean, well, first on the valuation point, I mean, for the amount I'm asked about valuations, like my answer is still surprisingly terrible, because it's so subjective. Honestly, like when people try and make a complete science out of it, it's not quite ever correct, because literally every business is different, and particularly in different sectors. Like the closest you could probably go is doing comparables in the same subsector, maybe, but even then there'll be subjective differences between the businesses. What we'll tend to see is a really basic one will be a multiple of revenue. For example, we've got 400 businesses in our portfolio, and to be honest, I'll see more loss-making companies probably than even Will does. Not even Will, but just because he mentioned loss-making before. And to be honest, it's still a big headline grabber. You'll get the FT and the Times and other publications sometimes like talking about Monzo, for example, being loss-making, and it's, well, actually they're spending a huge amount of their investment money still acquiring customers and marketing. There is a path to profitability there. Like the fact they're loss-making isn't the end of the story. And I think actually that's something that we are always looking to buy into and look beyond. It's I think Will articulated it really well. It's kind of like, will those founders, do they have the hustle? Do they have the addressable market to get to a point actually where this is a future winner? It's not always going to be loss making, obviously. So that's the first point on there. For evaluation, yeah, I'd say it's a good start to kind of look at turnover and do a multiple of that. We've got a startup valuation calculator actually on Seedrs.com website, which is probably more harm than it's worth, actually, because then people will come to us and say, yeah, but you said I could do 5 million, so therefore, yeah, Ross has said like I'm 5 million, no, done. But it's a good start. It's a good start as any to try and give some basis for it. Some other things to think about. We've actually been doing quite a lot of convertibles this year, and without wanting to get too boring or confusing, convertible is essentially the way that we run it. It's not an equity round. It's a loan which might convert to equity at your next round. And the advantage for that is actually you're not putting a valuation on the business for this round particularly. It'll convert at a discount next time. Hopefully that wasn't too much random jargon. But it obviously quite attractive for businesses, for example, in hospitality this year. As just mentioned, some D2C brands have had a real struggle this year with COVID, and there's countless other sectors that have really struggled. Actually, potentially quite attractive for them to look at a kind of fundraise without evaluation for this time. It's also had the added benefit that we've had some great UK focused like government initiatives like the Future Fund, which are also on convertible terms. For an equity side, yeah, you always want to look at things like board seats, preferential shares, and dilution rights for an investor. But I won't bother talking about that because it's really well.
Quickly on that one, is there, from your multiple rounds of funding, is there things that you prioritize other than the valuation?
Yeah, absolutely. So I think while valuation is important, I do think that we would always go with the right investor first, even if it was at a slightly lower valuation than pushing through a certain valuation. I feel like valuation is really an art. Both sides have to agree on it, but most importantly is that the investor and the brand are really aligned, because you will be working with that investor very closely for probably through the end of the business. So it's super important that you're aligned and that you can work well together. And in that regard, I think board seats are important. Typically in like the very early rounds, like an angel round or the seed round, you don't give away board seats, but as you go into your Series A, you have to think about that. And for us, it was important that it was my co-founder and I originally on the board, that we gave away one additional board seat, but and board observer rights, but we still wanted to have the control within us. That was something that was important to us. And vice versa, investors that accepted that then wanted certain veto rights on us raising additional debt or spending large amounts of money on certain things without them approving. So that was a little bit the back and forth. And lastly, I think one thing that is very important and that comes up especially in all rounds, but especially in early rounds, is vesting, where investors want to put the founders on a vesting schedule, meaning that your equity that you have is not yours anymore right now, right away, but you have to wait, let's say 3-4 years and earn the equity back or the additional equity. And I think even though it sounds confusing and potentially frustrating to founders, I think it's a very important concept, because it makes sure that you stay on board for the next years, that you're not raising money and then leaving the business. And it is especially important when you have a co-founder, because you want to make sure that both of you are aligned and both of you stay on board.
Yeah, absolutely. Thanks for that. Moving on to I guess getting the pitch right. And I'm going to start with Jess, because you told us beforehand, which I love, that a lot of your original investors came from cold emails. We'll have a lot of people watching this that are early stage founders that don't have, particular connection to VCs or equity businesses or anything really. And you did the same. You started from afresh. How did you get in front of the investors that you found?
Yeah, I think like Chris said before, like you start by putting a list of people together. And for us, not knowing anyone, it was really about Google and cold emails. And I think what's important, we're selling jewelry, we're a jewelry brand. So we know it's something that talks much more to women. And at the same time, we know as well that they will understand the product much better, and it's easier for us to sell our vision. So that's something we focused on. It's really looking at people that have the same interest, come from kind of the same background in terms of experience, so they can really like relate. So to be honest, like at first we reached out to mostly women entrepreneurs that are starting to invest in companies as angel investors, but that aren't per se like the biggest, more active angels. And so we started reaching out, as you said, by sending cold email, just telling them about our vision, telling them about our product, what we've achieved in just a few months' time, and seeing if they're interested. But definitely, I think like we didn't know anyone, and no one really helped us from the beginning. But then if you get in touch with the right people and like, just like don't hesitate to chase as well. Like at one point they're gonna get back to you, even if it's a no. And then like if one person likes your idea, it's a very small network. Like most angels investors, let's say in London, they know each other. Most angels investors in Paris know each other. It's like the entire investment world is like tiny. So if you get in front of the two women that like, or two investors that like your product, they're quickly going to introduce you to others. Yeah. And then it's like a vicious circle where like you get an intro to someone that introduces you to someone else. And that's how we basically did it. But yeah, definitely cold emails and like never taking no for an answer, and trying to see in your close network, like who can intro you to someone that knows someone. And yeah, don't be scared asking for intros either.
Yeah, that actually brings me on sort of to my next point, which is, and Will, you touched on this, and Chris, so I want to go into it a little bit more, which is, what do you look for when you're, what should a brand be looking for, a business be looking for when bringing on new investors, and how important is that character, culture fit, to take someone on?
It is massively important. My favorite kind of made up stat that I tell founders is that the average successful investment is going to last longer than the average marriage. So you're going to have investors who are going to be, as Chris was saying, they're on your board. They're going to ask for various kind of protection rights and visa service stuff. So you need to have a close relationship, and it needs to be somebody that you want to work with and feel like you'll get value out of them. Hopefully, that should come through in the pitching discussion. Kind of pitching is not a one-way street. You're not just selling your business to the investors. The investors should also be asking interesting questions, debating your strategy choices with you. Why are you using these channels to acquire customers rather than this? How are you thinking about encouraging repeat customer activation? How are you going to build your team out? Where are you going to hire next? And making introductions. Kind of, you shouldn't be afraid about asking investors for references. Kind of the majority of the investors you talk to, this won't be their first investment. They'll kind of either angels or VCs that will invest in other businesses. You can ask them to connect you to founders they've invested with before. You can kind of reference on them. You can look when you're kind of deciding who you want to go and speak to, look at kind of where else they've invested, what else is on their CV, give them a little stalk on LinkedIn and Twitter, see what they've been talking about, tweeting about. Kind of, you're trying to find people that you think you'll get value out of beyond just the money. Kind of, at the very least, you need to get money from them. You definitely don't want anyone that's going to kind of pull any shenanigans or be harmful. You don't want to be in the midst of closing that critical kind of next round of funding and they refuse to sign documents because they're upset that you didn't communicate with them regularly enough, or they didn't agree with the direction you've taken the business. But I did. You want someone who you're going to kind of get to the end of the year, look back and go, wow, they made a couple of really impactful introductions, or really helped us get our head around our acquisition strategy, or how we're getting multi-channel, or whatever it is. So that's the promise. Whether VCs live up to it, I can't say, but we try.
Ross,
yeah, I think, sorry, actually, yeah, I was just about to add to that point, actually. I think it's, you hear the term smart money branched about quite a lot, and I think that the significance of that is, and I appreciate sometimes it's easier to say this than it is in practice, but you don't necessarily just want the cash for the cash's sake. Like, some investors actually can bring a network and expertise, you know, an audience to your product or your business that, you know, that they can essentially open doors for you that you might not have had before. So actually, exactly that, almost putting the challenge to them to see how they can better your business, not just through an investment, is super important to do for a founder. Sorry, Josh, you were going to ask me something.
I was going to say, what advice you have for brands who are dealing with hundreds of investors, but I'll leave that for now. I'll ask you one more question before and then I'm going to ask the guys again, and we'll go to the Q&A. But for you must have seen tons of different pitches come through over the last few years. Would you tell us maybe about one or two very quickly, the best pitches that you've seen, the best brands that came out of that?
Is that for me? Sorry. Yeah. Okay. Cool. We think some particular interesting ones. So there was a really great company that did around with us around about summer last year, called Rubies in the Rubble, who essentially, I didn't buy into an awful lot of sort of vegan FMCG before I saw what they did, and actually, like, they do really simple things, which is make sauces out of discarded fruit and veg. So they made like a mayonnaise with aquafaba, which is the like the water drainage from a chickpea. I sound very hipster when I say this. And it's actually like amazing mayonnaise. You don't need to use eggs for it. And they made like ketchup with pears, and it was just really, really good. And actually, it was one of the first times that we've seen a VC firm actually invested in a company having seen them through our platform. So normally it's a different kind of scenario, like a venture capital money's already lined up and they kind of come to the crowd for a top up, sort of for the marketing and PR exposure. But actually it was an EIS fund called Pembroke VCT, and they saw them on our platform already doing really well. And they came with a target of 350K, and they ended up closing on 2.1 million. Yeah, just look at the brand. They did a really cool video. It's like, yeah, just a really, really nice sort of glossy product, and a great example of how to crowdfund well and get people onto your story. I mean, there's probably countless numbers of like really strong fintechs and insurtechs I could have mentioned, but I'll go for for a vegan condiments brand.
Amazing. And then my final question before we go to a Q&A, and if you have any questions, please submit them now, is going to the two founders, to Jess and to Chris. Chris, I'll start with you. How do you deal with the stress of running a business and raising investment, which is two very different full-time jobs, I think?
Yeah, absolutely. It is really like that you're working two jobs at that time. It was especially hard very early on when it was just my co-founder and me working on Koio and trying to raise money, where most of the time would be dedicated to raising funds, and you had very little time to really bring the business forward. It just meant that you had to work longer and harder to get it done. Now it's a little bit better that we have a team. So the day-to-day operations part is not really like falling on us, so that we can rely on the team to like get the brand forward and keep heading into the direction that we set up. At the same time, it does take up a lot of your time, and you want to raise the right amount that gives you runway of, let's say, 1.5 to 2.5 years, so that you don't have to constantly go out and raise more money. And one other strategy that has been helping is where we split up in the co-founder team, that one person is focusing more on fundraising and one person is more focusing on leading the team in the operations and marketing during that time.
Jess, you're at an earlier stage, obviously.
So no, for sure. I think it's a full-time job. So at first, when we went out raising, I was doing it like a bit for 2 hours in the morning and then back to work. And at one point, I just realized, like, if you want to raise funds, like, you need to be all in. So like for a month, that all I was doing is like taking calls, like every hour we had like different calls, sending emails at night to get the answer on the next day. But I'm lucky enough, as Chris said, to have a co-founder. So we're really well split in our roles. So I was going out pitching while she could manage the other part of the business. But yeah, for sure, I guess Chris has more of the experience because he's done it a couple of times. But I think it's definitely important to raise enough not to have, like, in order not to go out every 2 months to get more funds.
Yeah, I'm sure. So that was amazing. I'm going to go straight into the questions because we're running out of time, and there are a few really good ones here. And actually, the first question I'm going to ask relates exactly to Jess's point, which and it's directed at Will. So, Will, a lot of people say they prefer not to invest in startups with only one founder. How do you advise a founder who has no business partner to get around this?
Yeah, so we've definitely invested in a bunch of sole founder startups. Kind of, I suppose I should qualify this, that the stage at which we're investing is not when it's just the one man band. Kind of, we're typically investing at the point where there's kind of that at or around first customers. So there'll be a small team, kind of 5, 10, 15 people in place. That's kind of the earliest that we go. But when we're looking at investing in businesses, we're thinking about, compared to the stage that it's at, is there an appropriate mix of kind of high quality leadership kind of level skills in place around the business? What's there, what's missing, what do they need to hire in over the next 6 to 12 months? And are those people kind of suitably incentivized to build the business? So good example of this would be, so invested brand-wise in Spoke, which is a kind of London-based menswear company doing chinos online. Ben there's the sole founder in charge, but he, at the point at which we led their seed round way back in 2015, he brought on board basically a late co-founder that came on board later on and kind of was just a voice within the management team who had enough experience to give him kind of strategic challenge within the business, and so kind of filled part of the co-founder role. But it's about the balance of the team, and you can always go and find kind of mentors or advisors or legal investors to do that kind of day-to-day challenge on that you would chat through with the co-founder usually. So there's ways to box around it, but you will over time need to build out that kind of balanced team.
Thanks for that. And the next question is what advice would you give to a first-time founder? And there's another question here which says, do you guys have any advice for someone who's I guess a first-time founder that's also holding down a full-time job? Chris, advice for first-time founders. Where do you start?
So one thing that has helped us incredibly at the beginning, we are first-time founders. We had not worked in fashion before. We hadn't done startups before, but had very different backgrounds. And what was incredibly important for us was to build credibility, to build credibility and build momentum. So we started building an advisory board early on, where one of our very early advisors was Neil Blumenthal from Warby at the time. And yeah, and we had a bunch of other advisors on it. We gave them a very small share of equity, and in exchange, we got to meet with them on a regular basis so that we could benefit from their knowledge, but we would also get access to their network, and we would have their name backing us in a way as we would go out to investors. And that really helped us a lot early on, because similar to what Jess said, is like, once you get access to someone's network, it's a snowball effect, and you can ask people for more introductions. Like, I remember we had a rule at the time when we were going out to raise our first round, that we would end every meeting with the question, who else should I be talking to? Asking that question to the person that we were just meeting with, which helped us a lot. And then in managing these early relationships, one thing that we found very successful in order to build momentum was to keep investors or potential investors and interested parties updated on a frequent basis. They're probably not going to give you a yes as the first party or very early on. So you just need to keep them posted. We would send them messages every 2 to 3 weeks, or maybe even every week, with like new big press hits, like new milestones that we achieved, new parties that were interested in the round, and we try to like get some momentum with the investors like that early on.
For sure. And the next question, again, sort of leads on from that, which is they say, for a product that needs significant investment to build, e.g. an app, I think this one's probably for you, Will. What advice would you give them to help prove the concept when investment is required to build a product?
Yes, it's about kind of working out how you can prove out that there will be product market fit once the product's built. So kind of getting out there, talking to users, conducting surveys, kind of go and do a bit of searching online. There's plenty of resources online to see this, but kind of where if you're sitting there saying, and it's building an app for a reason, there's investors obviously taking on technical risk that will you be able to build that app. We're usually kind of verifying that by kind of getting helpful with that by the background and the skill set of the team who are building it, and kind of how novel or not what you're trying to build is from a technical point of view. But there's also the risk of, if you build it, will anybody care? Will customers actually want to use your app? And that you can try to pre-verify and talk to people. You can do kind of growth hacking techniques around kind of creating a landing page, doing kind of waiting lists and pre-sign-ups that can verify that there's appetite out there. So it's about trying to think about what are those easy ways you can do to show that the demand is really there.
Yeah, absolutely. Guys, I think I'm going to end it there, and we've run out of time, but that was an amazing panel. I appreciate all of your times. I know that our community would have done as well. Thank you guys all for joining us. For any questions that weren't answered, I'm sorry that we've run out of time, but we'll try and answer them in the post-event write-up. But again, guys, thank you so much. And really enjoyed that, and I'll see you guys at the next one.